What is a call ratio back spread? How to get minimum profit. The call ratio back spread is a POPSHI bullish option strategy that profits from a significant upward movement in the underlying asset's price, in this case, a cryptocurrency like Bitcoin or Ethereum. It's designed to have unlimited profit potential on the upside and limited or even a small profit on the downside. It's typically implemented when you anticipate a sharp increase in volatility and price for the cryptocurrency. The ratio refers to the fact that you buy more call options than you sell. A common ratio is 2.1, meaning you buy 2 higher strike calls for every 1 lower strike call you sell. Step-by-step process for a call ratio back spread. Crypto options in USA. Step 1. Market analysis and cryptocurrency selection. 1. Identify a bullish crypto asset. Choose a cryptocurrency, e.g., BTC, ETH, that you believe is poised for a significant upward price movement and increased volatility. This could be due to upcoming news, technical analysis, or fundamental developments. 2. Research crypto options exchanges. In the USA, you'll need to use a regulated exchange that offers crypto options trading. Ensure the exchange is compliant with US regulations, e.g., CFTC FinCEN rules for derivatives. Examples may include regulated platforms that offer options on crypto futures. 3. Understand market conditions. Confirm that your analysis points to a strong upward trend and potential for increased volatility. This strategy performs poorly in stagnant or moderately bullish markets. Step 2. Strategy construction, the trade setup. The typical structure for a call ratio back spread is to sell 1 in the money, ITM or at the money, ON call option, and buy 2 out of the money, OTA call options. With the same expiration date, let's assume the current price of your chosen cryptocurrency, e.g., BTC, is $60,000. 1. Sell 1 lower strike call, ITM or ATM. Action. Sell 1 contract of a call option with a strike price below or at the current crypto price. Example. Sell 1 BTC call option with a strike price of $59,000 if BTC is at $60,000. You will receive a premium for selling this call. This helps offset the cost of the long calls and can even result in a net credit. 2. Buy 2 higher strike calls, OTM. Action. Buy 2 contracts of call options with a strike price above the current crypto price and above the strike price of the call you sold. Example. Buy 2 BTC call options with a strike price of $62,000. You will pay a premium for buying these calls. Important. All options must have the same expiration date. Step 3. Calculating premiums and net debit/credit. Net premium. Calculate the total premium received from the short calls minus the total premium paid for the long calls. Net credit. If premium received from short calls, premium paid for long calls, you receive a net credit when you enter the trade. This is generally preferred for this strategy as it reduces your maximum loss to the premium received if the price falls. Net debit. If premium received from short calls, premium paid for long calls, you pay a net debit when you enter the trade. Your maximum loss will be this net debit if the price falls within the loss zone. Step 4. Defining profit and loss scenarios. Maximum profit, unlimited. Your profit is theoretically unlimited if the cryptocurrency price rises significantly above the strike price of your long calls. The 2 long calls will gain value much faster than the single short call loses value. Maximum loss, limited. The maximum loss occurs if the cryptocurrency price at expiration is somewhere between the strike price of the short call and the strike price of the long calls. If you establish the trade for a net credit, your maximum loss is the difference between the strike prices minus the net credit received. If you establish the trade for a net debit, your maximum loss is the difference between the strike prices plus the net debit paid. Break-even points. A call ratio back spread typically has two break-even points. Lower break-even, roughly the short call strike price plus net credit received or net debit paid. Upper break-even, roughly the higher strike price plus maximum loss. Step 5. Trade execution. 1. Select your broker exchange. Choose a reputable platform that supports crypto options trading and operates legally in the USA. 2. Place orders simultaneously. To ensure the correct ratio and pricing, it's best to place these as a multi-leg order if your platform supports it. Otherwise, execute the legs as close to simultaneously as possible to minimize slippage. Step 6. Monitoring and management. 1. Monitor price action. Closely track the price of the underlying cryptocurrency and its implied volatility. 2. Adjusting the trade. If price rises sharply, you might consider taking profits on one of the long calls or adjusting the spread to lock in gains. If price remains stagnant or falls, the strategy will likely experience losses due to time decay and the diminishing value of your long calls. You might consider closing the position to limit losses or rolling the options to a later expiration date. Volatility changes. If implied volatility increases, it benefits your position. If it decreases, it works against you, especially on the long calls. 3. Exit strategy. Have a clear exit strategy. This could be a target profit level, a stop-loss point, or a specific time before expiration when you close the trade. To close the position, buy back the short calls and sell the long calls. How to get minimum profit. Achieving minimum profit with a call ratio. Backspread typically involves two main scenarios. 1. Establishing a net credit. If you can structure the spread such that the premium received from selling the lower strike call is greater than the total premium paid for buying the two higher strike calls, you establish the trade for a net credit. If the underlying cryptocurrency price falls below your lower strike price by expiration, all options will expire worthless, and you will retain this net credit as profit. This is often considered the minimum profit scenario on the downside. To achieve this, you need to find options with premiums that allow for this imbalance. This usually means the short call is relatively deep, ITM, and/or has higher implied volatility than the OTM long calls. Price stagnation, slightly above lower break-even. If the price of the underlying cryptocurrency at expiration finishes just above your lower break-even point, which is often around the strike price of the short call plus any net credit received, you might also realize a small profit. In this scenario, the short call might be slightly in the money, but the long calls expire worthless, and the initial credit, or minimal debit, helps in generating a small gain. Important considerations for minimum profit. Option selection. Carefully choose your strike prices and expiration dates. The more OTM your long calls are, the cheaper they will be, increasing the chance of a net credit. However, they also require a larger move to become profitable. Volatility. Higher implied volatility on the short call relative to the long calls can help achieve a net credit. Time decay. While time decay generally hurts this strategy, if you establish a net credit and the price stays below the short strike, time decay will work in your favor as all options decay to zero, allowing you to keep the premium. Commissions. Factor in commissions and fees, as these can eat into small profits or increase losses, especially with multiple legs. Example for minimum profit. Net credit scenario. Let's say BTC is at $60,000 and you want to implement a call ratio back spread aiming for a net credit. Sell one BTC call at $58,000 strike, ITM, expiring in 30 days for $1,500 premium. Buy two BTC calls at $63,000 strike, OTM, expiring in 30 days for $1,000 each, $2 total premium. Net credit. $2,500 received, $2,000 paid, ETUs, $500 net credit. Scenario for minimum profit. If, at expiration, BTC is at or below 58,000, all options expire worthless. You keep the 500 net credit as profit. This is your minimum profit in the downside scenario. Remember, the goal of this strategy is often for significant upside profit. The minimum profit, or limited loss, aspect is a risk management feature built into the spread, particularly when structured for a net credit. Please like, subscribe, and comment.